CNBC-TV18, embarking on a quarter century of excellence.
Hello and welcome to the CNBC-TV18 Mumbai studio. I'm Ekta Batra and you're watching Your Stocks. Well, what the market was probably fearing a little bit is coming through now. There is a correction which is taking place in the markets as we speak. We have the mid-cap index which is down around 925 odd points and rapidly falling, as you can see from the day's high. In fact, an intraday chart will tell you more in terms of the kind of correction that we've seen for the mid-cap index, which is corrected over 1,370 odd points, almost 3 odd % from the day's high. Similar concerns coming in for the Nifty, which is down around 135 odd points at this point in time, so down around 0.6%. The sensex, which is down around 355 odd points. In terms of the advanced decline ratio, it's completely switched towards the declining side. Remember, for most of the trading session, we have been maintaining that advanced decline ratio in a steady form, but right now we have around 1,032 stocks advancing to around 2,959 stocks declining. The ratio currently stands at around 1:3. Remember that while we are seeing this profit booking taking place, it is important to put the rally that we've seen into context as well. So the correction has to be seen in context of the rally that we've seen. For example, the mid-cap index has rallied around 41% on a year-to-date basis. We have the Nifty 50, which is up 17.7% on a year-to-date basis. The sensex, which is up around 16 odd %. If you look at the US markets, the S&P is also rallied around 24% year to date. So we are sitting on heady gains across global equities this year. Most of the markets have given returns, and hence there is some amount of profits being taken off the table in order to basically enjoy the outperformance that we've seen. But nonetheless, it is the rapid fall in the mid-caps and the sudden intraday fall that we've seen which might deter sentiment. So let's get in our experts to talk a little more about it. We have Rajat Bose of rajatkbose.com, Parthiv Shah joining in on the fundamentals as well. Rajat as well as Parthiv, welcome to the show. One never thinks, Rajat, that correction is probably going to come through. And it's always worse when it is for the broader markets as compared to, say, your frontline indices, something that we're seeing as of now, because now the mid-caps are down around 1,060 odd points. How would you approach this?
Good afternoon, Ekta, and thank you for having me. Season's greetings from my side. Coming to talk about the indices, the most important feature of today's trading is that mid-cap index is correcting, and it has already taken down the 9-day exponential moving average. Generally, this 9-day exponential moving average tends to give support when it actually goes up. I mean, on any intermediate uptrend, this moving average is very, very crucial. And now it has been taken out. It was at 44,899, and currently it is at 44,433. So more than 500 points below even that moving average. So this correction was anyway overdue. There has to be some kind of a correction because it was getting a bit too top heavy. Coming to talk about the Nifty, I would say that on your channel, even earlier also, I said that 21,493 to about 21,507 is a critical resistance level. That has also been taken out, but on the weekly chart, the 21,757 to about 21,800 has been the major resistance level. Till such time, we don't see the Nifty falling much below the current levels, especially if it were to fall below the 21,000 level, then probably you will see that the 9-day exponential moving average for the Nifty would also be taken out. Only the bank Nifty is relatively healthier in the sense that it is only 0.5% fall. But otherwise, you should not be worrying too much, because this is just a small correction. It's a course correction. Since 26th October till to date, almost 60 days, perhaps a little less than that, we are rising. So this correction was very much in order.
Okay, all right, fair enough. This correction was very much in order, but I think, Rajat, there is this intraday correction which has taken place, which is probably going to deter investors a little bit. How would you read that? Because we started out quite stable in terms of trade. The global cues were supportive, but now there seems to be a sudden shift in sentiment intraday.
Well, Ekta, one thing I would like to highlight here is that this correction is not just an intraday correction, because you see, today's high was 21,593 and it began at 21,543. And the kind of candle that is developing in today's session, it is engulfing previous 4 trading sessions. So generally we call if the prior candle, if that is engulfs, we call it a bearish engulfing pattern. But this is a pattern that has got much more import, in the sense that it is engulfing at the moment. If it closes around these levels currently, wherever it is, then it will be encapsulating previous 4 sessions trading activity and the kind of flourishes that we saw. So it is pretty damaging from that perspective. But I would say, as I said earlier, the 21,161, where the 9-day exponential moving average is located, until and unless that you see that that is violated decisively, it can again bounce back, despite the fact that it is an engulfing pattern. It is encapsulating 4 trading prior to 4 trading days trading activity. That is damaging in any case, but so long as the 9-day supports it, you can see a bounce once again. But I have suggested on my YouTube channel, I've suggested to my clients that at least book 50% profits, because you have got enough. A phenomenal bull run we have seen. So at least some profit taking you should be expecting. And I'm not really worried, at least as of now, that because not all hell has broken loose.
Okay, all right. When you're sitting on gains of around 41%, even a 2.5% fall can really scare you. I think it's that kind of market. But just want to point out that the BSE small cap index is down around 3% as well. So that's the other index. Remember that we're sitting on gains of around 42% for the BSE small cap index. So that's the kind of gains that we've seen. And in today's trading session, that particular index has fallen around 3%. As you can see, over 300 odd points shaved off from the Nifty, from the high point of the day. And for the mid caps, as we speak, recovered a tad bit from the day's low. We were down over around 1100 odd points at one point in time for the mid cap index. It's recovered to a cut of around 934 odd points, but still sitting with a cut of around 2%. But let's get in some queries now. We have Kamal Kapoor, who writes to us from New Delhi. He holds 20 shares of State Bank of India, which is bought at around 400 odd rupees. He wants to know what to do, whether he should remain invested or exit at current levels. Well, Parthiv, coming to you on this particular stock, SBI hasn't participated as much as its peers this year in terms of the PSU banking index rally that we've seen. Do you then think that maybe this would probably be a good buy just based on the fact that it's underperformed?
Good afternoon, Ekta, Rajata. See, if you look at this entire rally in the markets, especially the broader rallies, I think the banking segment, especially the frontline banking names, which includes likes of PSUs like SBI, even that of the private sector bankers like HDFC Bank or Kotak Bank, they have been languishing. They haven't really participated in the rally. This is despite the fact that the fundamentals for the banking pack are changing for the good. If you see SBI, quarter on quarter, they've been reporting very stellar numbers, record profitability, and relatively in terms of the credit cost, also they are showing very good performance. And this is one bank in the PSU pack which is surely headed for improvement in the return ratios going ahead, whether we talk of ROAs or ROEs. And they are very target oriented at this stage. And even in terms of disbursements, I think they are extremely well capitalized to disburse loans at the rate of around 12 to 15%. And on their base of 12 to 15%, I think that is a fantastic growth. So our sense is that the bank's valuations are cheap. One should certainly hold on for the next 2 to 3 years and enjoy this rally.
Okay, all right. And what about you, Rajat? What would you recommend on SBI? A little bit of profit taking, probably?
I would say that yes, it is a little bit of profit taking, although the candle is again another bearish engulfing pattern. But SBI has not really moved up so much. Well, say compared to PNB and lots of other PSU banks, SBI has moved up something like a little over 20%, maybe 22% from the recent low that was around 540 in the month of October. So SBI also has not fallen below its 9-day moving average at 633. So let it fall below that and let it sustain there. Then even then, I would say major support lies between the 20-day moving average around 600 and there is a good support around 580. So if 580 were to be taken out, then you would say that banking rally is over. But I completely agree with Parthiv that things are turning out for the better fundamentally for banks. So maybe this is just a course correction.
Okay, all right. Maybe this is just a course correction that we're seeing for our markets at this point in time. We have the Bank Nifty, which is relatively lesser scathed as compared to the other indices. So the Bank Nifty is down around 260 odd points, mid caps down around 960 odd points. The Nifty currently at around 21,284. The sensex holding above 71,000. We'll take a short break, but we'll answer more of your queries on the other side. Stay tuned. Welcome back. Well, let's get in a couple of more queries in what is a volatile market this afternoon. We have Rahul Khanna, who writes to us from Mumbai. He holds 20 shares of ITC, which he's bought at 200 rupees. He wants to know what to do, whether he should book his profits at these levels. Well, Parthiv, you go first on this one.
Certainly, Ekta, I think he should hold on. The reason being at 200 bucks, he locks in a fantastic dividend yield. And this dividend yield, our senses is going to go up because the way ITC is generating humongous amounts of cash flow, plus I think they have a very healthy dividend policy. And going ahead, even the FMCG business is due to deliver very good cash flows. I think overall, all segments of ITC should do well. The cigarette segment has been one of the frontline segments, generating almost 80% of the EBITDA. But going ahead, our sense is that the way FMCG business is also doing well, I think that should be a prominent business. The hotel and the paper business have also been stable businesses. And despite all this, if you compare with some of the other peers in the FMCG space, ITC is still quoting at a 15 to 20% valuation discount. So that we believe that one should hold on to ITC for the next 2 to 3 years.
Okay, and what about you, Rajat?
I would broadly concur with Parthiv again. The simple reason being ITC, the formation is that of a rounding. It's a saucer pattern, although the saucer pattern generally happens at the bottom, but this is actually a consolidating saucer pattern where say between August and October, it was in a range bound situation. Now it is trying to move up. And ITC currently at the price of 452.90, it is within a major support zone that is 454 to about 446. 446 is the 50-day moving average and 454 is the 9-day moving average, and around 450 is the 20-day moving average. Unless the 50-day moving average is broken down at 446, I would say that this dip should be used to buy. And what is my target? My target is again 499.
Okay, all right. So that's the word coming in on ITC. But let's get another question now. Sushil writes to us from Mumbai. He holds 3,000 shares of IREDA, which he's bought at 54 rupees, so already sitting on a big profit. He asks whether he can hold on to this share for the next 3 to 5 odd years. Well, very interesting question there, Parthiv. Since we don't have too much technical data on a stock such as this, considering it's a new listing, from a fundamental perspective, do you think that one, these gains will hold, and two, from a 3 to 5 year perspective, is it a good buy? Would we see further upside?
See, very frankly speaking, ever since the IPO and post listing, I think it has had a stellar run. In terms of price to book multiple, currently it's sitting at almost 4 price to book multiple, and on a forward basis, it's quoting at around 3.2 times. which I think for most of the PSUs, if you see on a historical basis in terms of the PSU-based NBFCs, I think that is something which is on a very expensive side. And our sense is that current outstanding loans of around 47,000 crore, we are very upbeat that it's going to grow by around 25 to 30% over the next 3 to 5 years. The way they have huge targets to disburse in the renewable energy space. But again, I think our concern is that current valuations do capture in the growth for the next 2 to 3 years. So if the gentleman is willing to wait for the next 2 to 3 years, probably a lot of it is already factored in, and it makes more prudent sense to kind of book out your gains and switch into something like a private sector bank where the valuations on a historical basis are cheap and more alpha could be generated there. Names like HDFC Bank or a Kotak Mahindra Bank.
Okay, all right, gentlemen. Well, on that note, we're going to let Rajat as well as Parthiv go. Thanks very much for joining in. Well, there is some respite in the market and buying at lower levels, which is coming through. The mid-cap index is currently down around 794 odd points. That's all the time that we have on the show. But do remember to send in all of your queries and email it to us, and we'll address them with our experts. Stay tuned. Closing bell up next.
CNBC TV18